Thank you, Senator Reed. Mr. Whitman, according to reports, the Jobs Act has been very helpful in aiding companies enter our capital and equity markets. But there's still a lot of concern that smaller companies are unable to tap into our equity markets. Given your role as a listing exchange, could you give us some of your thoughts on what can be done to help smaller companies IPO and what can be done to help small cap companies succeed in today's secondary markets?
Sure. There's probably two parts to the answer to that, and one is the recent move by the SEC with the tick size pilot to try to liquefy those less liquid small cap names. So we look forward to that program and measuring the effectiveness of that program to see how that works. We also, NASDAQ has initiated an alternative way to bring companies to the listed market through our private markets program. So with those two efforts, I think that we'll watch the growth of those newly small cap companies come to market.
Thank you very much. And this second question is addressed to all three members of the panel. I'd like you, if you would, please, to discuss with me what the proper role, if any, there is for dark pools in today's markets, especially for institutional investors. Is there a role for dark pools, or should we look at eliminating them?
I would say that the proper role for dark pools is probably how they were originally envisioned, which is as crossing networks for block trades, a way for institutional investors to put interest out there without tipping their hand to the market, not as a place that is extremely fragmented with order sizes that are the same as or smaller than the lit markets.
Yeah, I believe that there's a definite place in our market infrastructure for dark pools. As Mr. Cronin commented on the previous panel, as a representative of the institutional investors, you can't do large size in a displayed market at all times. And we would like to encourage more trading on exchange, but the fact is that a large order will impact the price adversely. And so having choices to place your orders in pools that don't display bids and offers and move the price before you're able to get your trade done is an important facility in today's marketplace. I believe that transparency, as referenced on the first panel, is something that could go a long way to helping improve the cohesiveness between displayed and non-displayed markets. That transparency around the rules within the engine, transparency around the pricing, and fairness amongst participants in those dark pools would go a long way to taking away some of the mystique about a dark pool. But the fact is that dark pools are a necessary, important part of the institutional trading tool set.
Thank you. Mr. Whitman?
So in short, we agree with the use of dark pools for institutional block size trading. But over the years, we've seen those facilities being used for more than just the facilitating of large block trading. The average trade size is now down in the 200 shares range. So, we believe there should be more transparency there. We think that the addition of all these dark pools helps fragment liquidity, which in the end hurts our, listed companies and listed companies on exchanges. So, block size is fine, but the proliferation of the use beyond that is beginning to be worrisome.
So, am I hearing that it would be appropriate or encouraged to prohibit smaller than the large block size transaction, and is part of the answers as simple as figuring out what that size is and prohibiting dark pools from engaging in that sector of business?
I'll go first and say that I'm not sure that I would support that. I think large institutions have a long history now of breaking their orders up into small sizes, and so even though the average execution size in a dark pool is a small number of shares, typically some number of those executions are a result of larger sizes that have been broken up and sent to the dark pools the same way they would have been sent to the exchanges. And so careful regulation here to make sure that we don't inadvertently take away tools from the institution, given that so much of their infrastructure has probably already been designed to break up their large orders, given the way the markets work.
I think that prohibition and this type of top-down regulation can be dangerous. We can see unintended consequences from it. One thing that we're pushing with the Healthy Markets platform is for a trade at rule, and for pilot tests around a trade at rule. I agree with Mr. Cronin from the earlier panel that a comprehensive trade at pilot would help us to see what the effects would be from imposing a burden to execute off exchange for small orders. And what it says is if you're going to damage the price discovery process on the lit markets by displaying your interest off exchange and executing off exchange, that there has to be significant price improvement with an exclusion for block trades. And I think that when you see the change in behavior that will encourage and the change in the dynamics of the types of orders that reach lit markets, it would be healthier for both the dark venues trying to facilitate block trades and the lit markets trying to improve liquidity.
Thank you.